How far can mining stocks fall? Stocks can shoot up and make you wealthy beyond your dreams, and drop hard even while the underlying metal price hasn't moved. Mining stocks are highly cyclical in nature, which is what attracts investors to the space. A steep 50% dive can be followed by a 500% rise. Some stocks mint millionaires, but in reality, most are losers for investors. However, because of cyclicality, massive amounts of share trading and capital are required to put in tops and bottoms. You may have heard of the term consolidation or digestion. In a previous edition of these videos, we profiled a dark market secret called shareholder turnover. It's a tool to help you understand when and how a stock couldn't put in a bottom or top. You can run any number of analytical tools, add trend lines to your favorite indicators, and try to confirm data. But in the end, the bottom comes when investors throw in the towel and have no more shares to sell. And the next major up move comes when a new fire hose of capital comes rushing in. This applies to tech, crypto, mining, energy, and every market sector. Once you're prepared and see the markets as they truly are, powerfully cyclical. So today, we're going to apply shareholder turnover to select stocks. This dark market secret you'll learn today is one you won't find on stock screeners or nearly any newsletter that you pay for. The share turnover ratio of major miners. Below is the share turnover ratio for Newmont, Barrick, Freeport-McMoRan, and Pan American Silver. These four companies have been around for over 20 years and have been excellent bellwethers for the sector over that time. Volume was exceptionally light back in the 1990s across the board, and it was highly liquid. Yet today's volume ratio is even lower than that correction. How about the dollar volume ratio? An even better apples to apples comparison uses the dollar volume ratio. It's the shares traded in a period times the average share price in that time, divided by the average shares outstanding. This formula shows the amount of capital required to take a stock from its high point through to its low point. This is important because it shows the actual amount of capital required to turn over the stock and the time required. Again, this ratio points out that if we are in a structural shift, we are nowhere near out of the woods yet for some of these mining stocks. Like we did for technology and bank stocks in a previous edition, the share price performance of these mining stocks is shown throughout the past downturns. Relative to the past downturns, there's a lot more pain on the way if we are in for a long bear market. Here's an example of Newmont mining from 1995 through to today. This puts the cyclicality and turnover requirements in perspective. Relative to the past two cycles, the dollar volume turnover ratio is nowhere near a level which would suggest a bottom. Have a look. What we find interesting about this is that since 1995, the bull market turnover ratios, 19 times and 16 times, are much larger than the bear market turnover ratios, 9.5 times and nearly 12.5 times. Here's the key take home. Every new bull market needs more capital to come in than it was previously wiped out in the bear market. This makes sense. The point of this analysis is to show what can happen in a global recession to share prices. If the global economy experiences bouts of elevated inflation, it's reasonable to expect a slowing down of the global economy. It's possible we move beyond the stagflationary environment into a serious deflation and even potentially a deep deflation. None of these outcomes are good for investors. If the global economy experiences a sharp but quick recession, the rate of turnover could be less. This leads us to a critical question. Where is the new capital going to come from to buy mining stocks? Millennials aren't buying mining stocks at the same rate as they're buying cryptos, NFTs, and tech stocks, or dumping them as of late. Over the last 30 years, baby boomers' capital was the largest flow of capital towards mining stocks, and that generation is now transitioning and preparing for retirement. Most boomers have had negative experiences with mining stock performance and are no longer willing to take the high-risk nature mining stocks. With that comes de-risking their portfolios. Here's the part where we'll anger most investors in the junior mining sector especially. Level up. The game's changed for the flow of capital. That means to attract capital, a mining company must be large enough in size and meet the liquidity metrics required by trading algorithms designed by the big quant and passive funds. And the metrics of the company are changing in real time. That means not just financial metrics like MCAP, EV, earnings, etc., but even ESG metrics, which we've covered in past editions. Where the primary asset is located, where the head office is, all that stuff matters. So here's a quick checklist. If you don't have an ESG or net zero plan, you're swimming upstream. If you're not listing on a tier 1 exchange, you're like an indie band playing the endless pub circuit in front of a handful of bartenders. If your primary asset is not in the US, the major capitalized passive index funds can't buy the shares. If the company is not listed on a major US exchange, the large US index funds can't buy the shares. If your mining company is run by a geologist who runs 6 other deals out of his Vancouver, Toronto office and no projects in the US, the index funds won't buy your shares. Look, we'll never be super popular mainstream analysts, especially among the rounder mining companies whose lifelines are the brokerage firms in Canada. But one of the gold companies in our portfolio is up nearly 5 times our money in the past 2 years because it met many of the above criteria. And that's in a market where most gold mining stocks are down 50 to 70% from their highs. Marin Katusa believes these stocks will go much higher. He's already placed big bets on another company in a similar jurisdiction with a tier 1 asset. And he believes that in due time, the passive funds will come up and scoop up the shares in this gold rush story too. If you want to get some of our in-depth research and know which companies Marin Katusa owns and is buying and at what price, consider becoming a member to Katusa's resource opportunities. You'll find in-depth examples of shareholder turnover charts and data on many of the KRO portfolio companies, and in simple terms that any investor can understand. Leave the hard part to our talented team. It's going to be a bumpy road ahead in the markets. Arm yourself with the best information. Keep it simple. Less is more, and focus on the big score.
Subscribe to the KRO, which is a Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.